Hi, this is Robert Pearies and the Portfolio Management Team broadcasting to you from Bias's Bermuda offices. We're in the boardroom here in Hamilton, Bermuda. We held our quarterly market briefing yesterday at the Hamilton Princess. We'll be going down to Cayman next week to the same at the Casuarina Westin on 7 Mile Beach in Cayman. We've just had the inauguration and the State of the Union address by President Obama, who was reelected for a second term. And as we look at the political environment, both in the U.S. and in other major industrialized nations, it's very clear that the political environment is quite marginal. And, of course, this creates implications with respect to the economic management of those countries that have a marginal political environment. In the U.S., you've got the Democrats, both in the White House, as well as having a 55% majority in the Senate, whereas in the Congress, the Republicans are in the majority with 53.7%. In Germany, Germany being the major economy of the European Economic Union, you've got Merkel as prime minister, forming the head of coalition. Her party, the Christian Democratic Union, only has 31% of the seats in the Legislative Assembly of Germany. So she's had to form a coalition with the FDP as well as the CSU to form 53%. So it's amazing that she's been able to hold a coalition of three parties together to form a government and then deal with all the complexities of and problems that the European Union has experienced. In the UK, you've got the Conservatives with 47% of the seats in the House of Parliament. They therefore could not form a government without forming a coalition with another party. So they've done that with the Liberal Democrats, which hold 9% of Parliament, and they've been able to have a majority. But the problem for them, of course, as with any coalition, is if the Liberal Democrats take umbrage to policies that the Conservatives are putting forward, they could break away and form a coalition with the Labour and some other minority parties. The really interesting country we think right now is Japan, where the lower house is ruled by the LDP, and the leader of that party is Abe. He's been made prime minister. They have 61% majority, so they have a clear legislative mandate, and that gets us very excited with respect to their legislative agenda and their ability to turn their rather stagnant economy around. But let's talk about the USA. We sort of refer to the budget difficulties in the U.S. as being subject to gridlock, and we sort of have what we've called on our strategy team the road to sequestration. You want to tell us about that, Dan?
Yes. Many of you recall our article at the end of last year discussing the fiscal cliff, which has now come and gone. And the other side of the revenue raises that were a centerpiece of the fiscal cliff discussions are spending cuts. So the argument being you can't just raise revenues, you have to cut spending as well in order to get closer to a sensible budget. Those cuts were termed sequestration, and it got the term because by law there would be an immediate reduction in spending in defense and entitlements. That was delayed until the 1st of March, which is only 2 weeks away. And when that happens, it will amount to $70 billion. I think the important thing to understand is that the fiscal cliff cost about $180 billion when you consider the tax rises, which was almost entirely where the money came from. People aren't going to feel that until later on in the year because it accumulates. The hit to the income and the cost in taxes being withheld will gather momentum as the year wears on, and individuals will begin to feel it more acutely as you get into the second half of the year. However, the sequestration cuts, the cuts in defense and entitlements, are immediate, and unlike sort of a a bad cold that gets worse, which is the fiscal cliff outcome, a metaphor for the spending cuts might be amputation, because suddenly you're going to have this immediate reduction in government spending, and it will be effectively with instant, and it will hit the economy very quickly and manifest itself in economic performance figures almost immediately.
So what's the drag on GDP again?
Well, for the sequestration is $70 billion, and of course you may recall the fiscal cliff outcome amounted to about $180 billion. So our analysis suggests $250 billion in total, which amounts to about 1.5% of GDP.
So it's a drag of 1.5% on U.S. GDP as a result of sequestration.
Sequestration and the tax rises. Sequestration alone amounts to about 0.7% drag on GDP.
Okay. So President Obama just did his first State of the Union speech following his re-election, and he really, in that speech, which I found quite interesting because he, for the most part, seems to have put the Republicans on their back heels with respect to points that he's pushing for. And there was a lot of economic content in his speech. And aside from gun control, I would say that the whole thing is with respect to economic initiatives. So he discussed quite a few initiatives. You want to tell us a bit about that?
Yes, I think they boil down into two main thrusts. The first one is immediate injection of economic boost to the economy, and then things that are going to be much more long dated. The more immediate things, the Fix It First program and cybersecurity, those are going to be immediate demands that the United States needs. The first Fix It First is about repairing the aging infrastructure, both from a governmental perspective as well as a partnership. And the cybersecurity, Mark will talk about a little bit later, but that's more on the defense side, an interesting one. There will be some initiatives that are going to take time to play out properly, like cutting energy waste, moving vehicles off fossil fuels, and establishing manufacturing innovative institutes around the country. So those are the two things. Some are bold and immediate, and others are going to take time to develop.
So we're gaining the impression here that central banks are carrying the ball for the politicians who have, in many countries, just made a mess of things. You want to talk about what the U.S. is doing with respect to getting that country back on track economically?
Right. Briefly, the Federal Reserve has always had a dual mandate of controlling inflation and fostering employment or reducing unemployment. And in an effort to do that, they have targeted numbers very specifically, beginning last year, where they are targeting a 2.5% inflation rate, and they will continue to keep rates low until unemployment falls to 6.5%. And they're doing that via asset purchases that amount currently to $85 billion a month, split almost equally between buying longer-dated Treasury bonds and about $40 billion a month of mortgage-backed securities. So the total is about $85 billion of asset purchases in order to keep rates under control.
Okay, and then tell us what Europe's doing.
Well, in Europe, of course, the ECB has pumped about $1.2 trillion into the Eurozone to stabilize the banking system in three separate programs, an alphabet soup of ideas. The largest was the long-term refinancing operation, which is now which was designed to support the banks, which they're now paying that money back. So the outcome, we think, is managed to offer support for the euro. If I could go on, the Bank of England, of course, has delivered about £375 billion into the UK economy, and that amounts to almost 12% of their GDP over the 2009-2012 period, clearly supporting the UK economy.
Now, Japan is interesting because it has for 20 years been underperforming economically and has had a very tight monetary policy and tight budget constraints. But with the new prime minister coming on board, they've instituted a bit of quantitative easing themselves.
That's right. They've decided to begin asset purchases like the rest of the banks, and they're buying $146 billion in Japanese government bonds per month for as long as necessary.
The other thing that Japan is doing is they are actively devaluing their currency or trying to drive their currency down, which is, of course, makes their exports cheaper. So hopefully they will get some export-led economic growth. The term that's come out in the press, and this, of course, is a media creation, is currency war. Do you think that we're in a currency war?
We don't believe we are. We believe that the information is too sparse and it's too early to make that judgment.
Right. So just to clarify to our listeners, you could create a definition for currency wars when nations devalue their currency relative to their trading partners to get a competitive advantage in making their products cheaper to export. So you don't think that's the case, and of course there are also there's certainly short-term benefits and incentives for countries to devalue their currencies. Why don't you tell us about them?
Well, very quickly, what we've discovered is on the short-term side, the benefits are that the nations are able to pay down their debt with a cheaper currency. Obviously, their currency is falling. It also improves trade balance over the short term because their exports become cheaper, and they're effectively stealing trade from someone else. And then finally, as an outgrowth of that, naturally, production costs fall because currency is cheaper. And as a consequence, employment improves. However, as you know, Robert, there are consequences.
Yeah, these are longer term, and I think politicians are probably willing to accept those longer term consequences in order to get the short-term benefits. So now Japan is quite interesting here in that they're kind of in a complex situation because they are sort of at increasing odds with China. For instance, in the most recent quarter, I think I saw a report that purchases of Japanese cars by the Chinese was down 70%. So there's a lot of animosity building up across the South China Sea. And it seems like there may be another motive of Japan, or need, I guess they would say, for strengthening their economy, is that they have this increasingly powerful neighbor nearby that they, on the one hand, need to rely on in terms of purchases of Japanese goods and services. On the other hand, is immense in terms of population and growing exponentially with respect to economic powers. So the Japanese preeminence in Asia is under threat, and so that could lead, in fact, to more interest by Japan in spurring economic growth.
Absolutely.
So, in summary, the USA has done a series of quantitative easing, targeting with the Fed targeting economy, jobs, and inflation. Inflation doesn't seem to be a problem. In the UK, we've got quantitative easing. The Bank of England is targeting the economy, inflation, and jobs again. That's what central banks are supposed to do. And the Eurozone, we have sort of new processes being developed by the Europeans that transcend national boundaries. Do you want to talk a bit about that?
Well, of course, they've committed to supporting the financial sector and also offered up support for nations that require funding in order to implement their austerity measures. And again, that's that alphabet soup of Eurozone projects, one of which now is being slowly repaid. But it amounted to about $1.2 trillion, which, given the Eurozone unemployment rate currently, as well as their recessionary economies, would indicate that perhaps they haven't done enough. The other point I want to make about Europe very quickly is they're only targeting inflation. They are not targeting jobs. They're the only major nation among the central banks. They're major central banks among the developed nations that does not target jobs at this point.
Okay, so Mr. Abe has a strong mandate in Japan. So what conclusion does that bring us here on the Bias Investment Strategy team?
We believe that we should overweight Japan for a variety of reasons. It's big. It reduces risk because it's not very correlated with the market, U.S. market, and Japanese companies at this point are very inexpensive.
Right. And I see that you've got the ticker symbols there. You want to tell us what those represent?
Right. The first one is a Japanese exposure that is hedges out the yen impact. And the second one is a broad exposure on Japan that is, in fact, has yen exposure to it, currency exposure. Okay,
so now let's get on to opportunities, and we've explained why our interest has singled out Japan for the political reasons we outlined. We are looking at other opportunities that sort of run along national boundaries. Tell us about Mexico, for instance.
Well, very quickly, we've positioned Mexico using an exchange-traded fund seen up in the corner. Mexico is an interesting opportunity in that it is the favorite of large bond investors. Most of Mexico's exports, 90%, fall under 18 different free trade agreements. They're allowed to export, of course, into North America duty-free. And they have a young, educated workforce that is highly literate.
Right. So one of the things that really caught my attention here was that Mexican wages average about $3.50 an hour. And although we don't have room for it on the slide, apparently it's now cheaper to manufacture in Mexico than it is in China.
That's correct.
And that doesn't include the cost of transportation? That's purely production?
That's production.
Okay, so that's why we're interested in Mexico. Talk about Peru. It's a bit of a smaller, obscure market, but tell us about Peru.
Well, Peru has many of the same characteristics as Mexico does. They are, in fact, young. They're highly literate. Government GDP, debt to GDP is very low. GDP growth is going to be 6% in 13 and 14, we believe, and it has a very diversified economy. In our view, it makes it a very attractive investment opportunity in Latin America.
Well, I want to bring Mark into the discussion here now because one of the topics of President Obama's State of the Union address had to do with cybersecurity, which he highlighted as being a real threat. Mark, you've become our in-house investigator stroke researcher with respect to all the dirty tricks going on in cyber world. Tell us a bit about this.
Thanks, Robert. Cybersecurity has become a real big thing, and last week President Obama actually signed an executive order bringing this into the forefront of their thinking. It's one of the 6 or 7 named topics on the State of the Union address. And so it's definitely going to happen during the course of the next 3 or 4 years of his administration. The insiders in the US believe that it's only a matter of time before there's a major cyber Pearl Harbor kind of event happening in the US. But again, other insiders are undecided how to cope with it because they're thinking that maybe the best defense is actually offense. And again, insiders have actually concluded that they're actually much better on offense than defense, 9 out of 10 versus 3 out of 10. And more interestingly enough, there's a gentleman by the name of Howard Schmidt who actually, his office is in the White House, and he's the U.S. head of government cybersecurity that's responsible for all the military, intelligence, business kind of applications of this initiative.
So it's not a isolated office somewhere in the massive government buildings in Washington. It's right there in the White House within arm's reach of President Obama.
Absolutely. It's front and center in his absolute interest, so it's going to happen. But it's not just a matter of national security. It does extend to business. So actually putting some numbers to it, the cost of intellectual property theft each year is around about $250 billion, which is a massive amount of money. And if you factor in the global cost of cybercrime of another $114 billion, taking it up to $388 billion if you include downtime, plus the remediation, i.e. that is putting it all right, well, that's a huge amount of money. That's remediation itself is $1 trillion on its own.
So businesses are going to invest in this in order to protect their proprietary interests.
That's absolutely correct. But let's talk a little bit about some specifics on the cyber side. And the next slide up here, it shows just some anecdotal information about what has taken place since 2009. There's a Chinese army unit, 61398, apparently, located in Shanghai, who are the hackers behind the theft of 24,000 files from Lockheed Martin's F-35 stealth fighter program. And 2 years later, after all those files have been taken, they produced their own stealth fighter, the J-20, which you can see up here. Doesn't look a million miles different from the F-35 stealth fighter.
And they've actually identified the building out of which these people work, which is a 12-story building in Shanghai.
That's correct. It's right downtown, front and center. But then again, the U.S. has been pretty busy on its own account. And the next thing they have done is, starting in 2010, the NSA, National Security Association, CIA, and the Israeli military put together a program to combat Iran's growing nuclear threat. And they created these two viruses. One's called the Flame virus and one's called the Stuxnet virus. The intent being to cause malfunctions in Iran's centrifuges. And it was meant to be pretty successful as well.
So this is someplace that business is going to invest. The companies that are involved in protecting our cyber environment are going to profit. And apparently there's quite a huge industry out there that we haven't paid that much attention to until now.
Large and growing, absolutely. The current estimates is worth about $18 billion a year in terms of total revenues to all the companies in this particular field. And the big thing, one other big thing that's driving it, is there is a upgrade cycle in firewall technology, and there's an essential shift from hardware solutions to problems to software solutions, and that's going to become a really big thing. So therefore what you have are participants are the large software companies who have created small divisions within them, like the likes of Intel, Cisco, Google, Oracle, and Microsoft. But there are also some smaller pure-play alternatives who just simply focus on the security aspect, and we've highlighted a couple down the bottom.
So with respect to the large companies, I mean, we've held Intel at various times and continue to hold Google and Microsoft. So we're already in this space in terms of the major companies, but in terms of getting gains that are more specifically attributed to this IT security industry, we're just starting to get into that area now. Talk to us about the two stocks that we decided to buy.
Thanks. Yeah, will do. Checkpoint, interesting company. It's based in Tel Aviv. It's the largest pure-play network security vendor in the world, and it's got a truly global spread. Split, America's about 45% of revenues, Europe's 37%, other, which includes Middle East, Asia, is about 18%. And that gives them a global market share of the whole entire industry of around about 15%. They're a big company, $10 billion in market cap, but what really caught our attention was the fact that they have a very high operating margin, which is around about 60% of their revenues, which is great. And that means they generate huge amounts of free cash flow. Currently, it's about $3.3 billion each year. And that's enabled them to start returning money to shareholders through a share buyback program. Currently, it's about $1 billion. And one of the companies we used for research purposes, Credit Suisse, called them their favored turnaround investment of 2013.
Right. So the other one that we bought is Fortinet.
Fortinet, yeah, it's another pure play, but this is a much smaller cap company. Interesting thing about Fortinet, like I said, it's about $4 billion worth of market cap. It's very much in its growth phase, so therefore their valuations, their ratios, they're looking a little bit stretched, but you would expect that in a very high growth phase, but they're still immensely profitable. For example, their revenue growth has been about 24% in the Americas, 25% in Europe, Middle East, and Africa, and 22% in the Pacific. And one good thing about Fortinet over the others is that they are a lower cost provider, and they provide a just simple one price solution, whereas some of the other companies, including Checkpoint and Cisco's and those guys, have a sort of more a la carte approach where you buy this service and that service and put them all together, and the actual overall cost is a little bit higher. Another good thing about Fortinet is that they're seeming to grow their business by winning ever bigger clients, and they're beating out the bigger players in actually obtaining those clients, the likes of Cisco. So they're going face to face with Cisco, which makes under them an interesting takeover possibility as well, because their competitors who are beating out in these contracts are either faced with the choice of developing new software solutions themselves or going and buying the company. So therefore we think it's a possibility that Cisco, who's actually said they are going to be more aggressive in acquiring smaller software companies, may view them as a takeover target. So we think it's a good investment play.
Yeah, I want to bring Dan back into the discussion now to get into a more cyclical aspect of what we see as a recovery. We look at a number of indicators and charts, and there seems to be a growing trend towards recovery. And one of the indicators of this is the housing sector, where sales are up, supplies declining, and rates to which mortgages are tied are starting to rise. So in the slides that follow here, Dan, just tell us a bit about these slides.
Very quickly, the existing home sales have risen. As you look at this slide, you can see there was a spike in 2010, but it sold off very rapidly. What we're seeing now, in our view, and our analysis indicates it's a much more sustainable trajectory that we think is a real housing recovery. Right.
And then on the next slide, we see that inventory has fallen.
Absolutely. Inventories come down from what were truly high levels to much more reasonable long-run levels at this point of about 4 months.
Right. And finally, with respect to mortgage rates, the 10-year Treasury, off of which fixed-rate mortgage rates are set, has started to move up in terms of yield. So that's going to cause mortgage rates to move up, and it's your view that there may be a rush to buy while fixed rates are still low.
There certainly is an incentive to do it now rather than wait.
So that gives us a good segue into the discussion on interest rates, because if we go back to February 2007, we see that interest rates were around the 5% market, and although slightly inverted, somewhat flat. You want to talk to us, Ingela, about what that means when you have a flat yield curve, and then go on to talk about the various changes since 2011 as we've gone into the Great Depression and are now heading towards recovery?
Absolutely, Robert. What we see when we have a flat yield curve is that the central bank has no intention of cutting rates. They keep the rates high because the economy is literally booming, is doing very well. But the yield curve in 2007 was slightly inverted, which could show that the market actually believes that something bad might be coming down the road. It's not going to be this great forever. And what happened up until 2009 is that in 2008, you all remember that the global banking system froze, and we had the Lehman crisis, and central banks around the globe with the Fed began cutting rates in a desperate attempt to try to stimulate their economies. And you can see this because yields came down massively from having been at around 4.9% for the 2-year yield in 2007. It came down to just below 1% in 2009, and even the longest yields came down. And then going over to 2010, there was some hope that we would get a recovery despite being in this deep recession globally. And yields actually came up a little bit from 2009. The 2-year yield was around 1.35% in 2010. But it didn't last forever, and we had the Eurozone crisis that came in, and yields started to fall again. And today, in February 2013, we all know that the U.S. unemployment rate is stuck at 7.8%, and as we mentioned earlier, the Fed has a target to keep their interest rates low until the unemployment rate hits 6.5% in the US. And today the 2-year yield is around 0.45% in the US, and the Fed is indicating to keep rates low, at least the shorter ones, for a long time.
So yesterday in the quarterly market briefing luncheon, one of our clients asked what our forecast was for interest rates and how long we're likely to stay at these current levels. Can you give us some clarity with respect to the future direction of interest rates?
Yeah, we believe that the Fed will actually keep on and stimulate the economy for quite a long time. The Fed themselves have mentioned 2015 for quite some time now that they will keep their rates low. So unless something dramatic happens with unemployment rate, we'll probably see very low short-term rates. However, longer-term rates, they have started to climb up, not very quickly, but they are climbing, as we saw in the chart on U.S. houses.
But indeed, the current yield curve indicates, because the yield curve you sort of mentioned earlier, but let's just repeat it, indicates what the market anticipates interest rates will be at some point in the future. So if you look at the 2-year U.S. Treasury, that's what the market expects the interest rates to be in 2015.
Yes, correct.
So going by this yield curve, this final yield curve for 2013, interest rates are going to be low at least till 2015, which is what the Fed has instructed the market it will do, and then starting to tip up in 2016.
Yes, absolutely, Robert. And this, it's not a very steep yield curve, but longer-term yields are higher than the shortest ones, which also indicates that there is hope in the market of a global recovery.
All right. Well, thank you so much, Ingela, Dan, and Mark, and for all of you listeners around the world that have managed to log in and listen to our views for the first quarter of 2013. We hope that you've enjoyed this synopsis of our quarterly market briefing, which we hold in both Bermuda and Cayman on a physical basis. We're happy to share this with you now. All the best, and if you would like to get more information about what we're thinking and where we're going and what we're doing in your portfolios, you're welcome to look on our various websites, which are on the final page of this presentation. All the best to you, and we look forward to speaking to you again next quarter.